Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from the Nasdaq Market site, and joining us for this segment, we have Scott Harrigan, CEO of Alto Securities, as well as Chris Dearborn and Maddie Radner on Nasdaq's Market Intelligence Desk. We're here to discuss the current state of investing, as well as how alternative investments can help to achieve long-term goals. It is great to have everyone with us. Welcome back to Trade Talks. And before we get into the strategy of incorporating alternative investments, I want to get an overview of the macro in the investing environment. It feels as if we came off a slow, kind of a gift week last week, but there really are a lot of factors to look forward to this week. I mean, we have Powell testifying, we have some key inflation data, we're kicking off earnings. Seems like we're going full into the fire this week.
Yeah, I think in talking to our investors specifically, I would say that we're seeing cautious optimism. I would say that, as you mentioned, with the interest rate environment and with the inflation-related impacts, along with some of the geopolitical impacts as well, I mean, we've seen a hesitation amongst the investor base that we feel is starting to loosen up a bit.
Yeah, do you think part of that is a result of the debates or getting closer to the U.S. election, or perhaps it's still too early for that?
Yeah, I think it's still too early for that, right? I think while people are watching it closely, I don't think it's gotten to the point where it's actually driving the decision making yet, but I'd anticipate over the next couple of months you're going to start to see that occur.
Yeah, well, Chris, perhaps, and we've discussed this last week as well, the market knows what to digest when it comes to a Biden house or a Trump house, right? We've experienced both of this. I think the bigger concern is whether, the ticket is split.
You have a lot of different questions about what certain things are going to be. But traditionally, a Republican presidency generally means lower taxes. It's good for investors. And when you look at that, it's good for business. Now, whether or not that impacts tariffs, which could impact inflation, or whether it's spending, driving up spending, which also can impact inflation and debt for the U.S., it comes down to whether or not the Democratic ticket can stay whole as it is with their policies as they move forward, which again is spending, but recently, especially with Trump's last presidency, there was a significant amount of more spending than we've seen with other Republicans. Usually, a Republican candidacy will have lower spending, lower taxes, more business-driven, business-friendly, and let it trickle-down effect, where the Democrats are bottoms up. They want to feed the bottom level, the people who need, and they want to maintain it and build it up from there. So it depends on which way you want to go. Trump, however, has been spending more when he was in office, which was very good for business overall, which was good for the stock market. The stock market had a great run, then we ran into COVID, and now the stock market's having another great run. So it comes back to what you said before a little bit, which is a little bit different than what Scott said, but similar. With the inflation issue that you're having, which is really originally was supply, then demand issues, and now you're starting to see the righting of the ship. The PCE came in a little bit lighter. We get CPI and PPI this week. The markets continue to move higher, and they move higher on growth, but it's still a concentrated market where you only have the top 20% of the S&P 500 moving higher. We're starting to see that move a little bit more. I looked at it for last week. Even though the markets had a wonderful week and a wonderful year, the S&P hit today. It's the 34th or 35th time they've been an all-time high this year alone. That it's really bifurcated between where it's moving, and we need to see that spread out. And I think moving into earnings over the next couple of weeks is where we're going to see that.
Yeah, and Maddie, that really is the question there, if this concentration in the market is going to continue, because you have to ask yourself, how sustainable are these earnings rates and revenue growth? And when you're looking at margins at 70%, and in NVIDIA's case as an example, are you focus more on the Russell 1000 and 2000 world? Are you starting to see some broadening out there?
Yeah, I think all eyes have been on the Russell 2000 lately, especially after the reconstitution, which took place on June 28th. So as of July 1st, we have a brand new group of companies, a new caliber of 2,000 small cap companies who are truly small cap companies. So we saw Super Micro get booted out, as well as a couple other kind of mega cap companies that really shouldn't have been in the 2000. They just saw incredible gains because of that AI theme. Super Micro actually went from a $14 billion company to about a $50 billion company within a few months. So they were really responsible for any positive performance that we saw in the Russell 2000. So I think all eyes really are on the 2000 now to see where they'll go from here and where Fed policy will impact those companies.
Right, because in fact, a majority of companies have been able to weather a higher interest rate environment quite well. right? And we're seeing that in those larger cap names. But let's say you want to remove yourself from the macro noise, you want to remove yourself from what's happening in the market and those narratives. Where do alternative investments fit in? How is it decoupled from that?
Yeah, I mean, if you think about the idea of the different categories within alts, specifically real estate, private equity, venture capital, they're non-correlated from the activity that's occurring in the public markets. And so, you know, the diversification into those asset classes, those alternative asset classes, really do provide some risk mitigation, sort of separating those investors, what's happening on a day in and day out basis in the market, in the public markets.
So when I think about alternative investments, I always think of high net worth investors or something that is highly illiquid. What should investors, how should they educate themselves when they're thinking about diversifying into alts?
Yeah, the alts game is no longer a ultra high net worth game. You know, our mission at Alto, in fact, the company's mission is, we say that we provide alternatives to help people secure their financial future. And when we say that, we're not talking about the ultra high net worth or institutional investors. We're talking about my mom and dad who ultimately never had access to these types of assets. And so I think that there's so much educational material available since this category has become front and center in terms of the investing community. You can just sort of Google and come up with thousands of informational pieces, and their videos and webinars and podcasts. We pride ourselves on the educational hub that Alto provides to our investors. Different investors learn different ways, and so we provide video, we provide long thought leadership blog, we provide webinars with Q&As, and so I think that there's just so much available today. It just has to be an aggressive investor that seeks the information.
Do you think that we've been seeing growth in alts, let's say private credit as an example, because institutions, you know, they're looking at different ways of financing, that they're getting more creative, perhaps it isn't traditionally going to a bank and having a relationship there, especially for smaller companies who need to get more creative when it comes to capital formation. Do you think that's part of the catalyst behind it?
I think it is. I mean, I think that category has been all the rage within the alt space over the past couple of years, and I think, Jill, you're exactly right. I think that you know, while some people are starting to question the continued momentum in that space, I think for all the reasons that you point out, it still is a category that is in high demand, especially with investors on our platform. So I continue to expect that trend, you know, going forward.
And Chris, continuing this conversation around capital and managing the balance sheets, what are you going to be listening for when it comes to earnings season that's about to kick off with the banks?
Right, we have the banks, not just the banks, we also have some big consumer names coming out the end of the week. Delta and Pepsi are going to give you a good look into two different areas of consumer staples and discretionary. So when you look at what's going to be happening here, what you're really concerned is looking back at Q2. The Q2 market itself, if you just look at the indices for the most part, you're talking the S&P 500, the Nasdaq, even the S&P mid-cap had a good quarter. Russell was basically flat, and the Dow was, you know, the Dow. You want to see what those companies had to say and how they're going to move forward. What, if nothing else, there's a high bar. We're looking at 9% growth for Q2. And with that, you're looking at not just what they say and how they achieve their numbers, but what their forecast is moving forward into an uncertain environment. You know, you have a hawkish pivot within the Fed. You've had higher rates for longer. You know, they're finally starting to come down a little bit. The expectations are maybe September, 70-75% chance of a cut right now based off of the recent non-farm payroll data as well as the PCE data. We'll see what CPI brings and PPI brings over the next couple of days. We have one more meeting at the end of the month, and then September. So the table's off for July meeting. There's nothing going to happen. So it comes down to companies are rewarded for forecasting moving forward and how well they get to the numbers that they're going to guide up to. And that's why AI has been such a driver. You know, we mentioned NVIDIA before, but anybody in that space right now is hitting their numbers. Even if you hit your numbers, but your guidance is weak, you will be punished.
Well, that's a concern about NVIDIA if you have a Micron kind of quarter.
But they haven't yet.
Right.
They haven't
yet. They hit everything on the mark,
right.
But the guidance wasn't quite what the street had expected. I mean, and my question is are we going to have to come to some sort of reconciliation, whether it's consensus getting back in line or, you know, the sustainability of being able to print these numbers?
I looked at the charts today. If you look at the chart of the Nasdaq 100 and the S&P 500, And not everyone's a chart person, but this thing called relative strength we've talked about before, and tells you an overbought and oversold condition. If you have a number of 70 or higher, it's significantly overbought. The S&P and the Nasdaq 100 are both in the mid 70s, 76 and 77, right? Even they've hit that number multiple times over the last 2.5 months, even as you're making higher highs. They have pulled back, but you haven't had that pullback yet in the broader market where you need some profit taking and a little bloodletting to let the market kind of right size itself.
Right.
The question is, what other sectors are going to help besides communications, which includes Meta and Alphabet, consumer, which includes Amazon, and then the tech space. We need the other sectors to start to pick up.
So, Maddie, we also discussed IPOs with you as another way to gauge the health of capital formation within the U.S. capital markets. Or are you seeing any? Feels like it was a little bit slower than we expected going into the second half.
Yeah, I think we are seeing a few potential IPOs to come in July again, but when we were discussing private company opportunity, we're actually seeing SPACs come back a little bit. So that's an opportunity. Maybe going public traditionally is a little bit more expensive for them. So we are seeing companies go the SPAC route, and that appetite is coming back. There were actually 17 SPACs so far across the U.S. exchanges this year. We have a big pipeline coming. There's over 200 companies on file to list in the U.S., SPAC or non-SPAC. So it is coming. I think earnings needs to get underway, the election needs to get underway, and those will trickle in with time.
Yeah, it feels like those are like the variables that are there.
Yes.
But Scott, I want to ask you about privates for a minute here. And it's not even just people who are more experienced in the market. What I find interesting, I read a survey that millennials, or the younger wealthy generation, they want to get into companies that were, let's call it the NVIDIA before they were in NVIDIA. And that's a big growth area in alts as well. Perhaps that's why companies are staying more private for longer, and they want to get in on like the AB and angel rounds.
Oh, I mean, I think when you think about the change in the way that the IPO space operated, years ago, and where most of the wealth was accumulated, post IPO versus today, the millennials and the Gen Zers see it, as you said. And I think that's why you're also seeing a trend in the market right now where some of the large retail brokers are trying to figure this space out. So historically, they had not taken an interest in alts, but I think based on the move into this space by millennials and the Gen Zers, they're forced to figure it out. And so even as recently as a couple months ago, you saw SoFi that came out and said that they're going to enter the space to satisfy this demand. I'd expect over the next couple months, you'll see some other announcements from some other very large retail brokers that do the same. I think the part we play in that is there are a handful of companies like Alto that specialize in this space that I think can be incredibly helpful to some of those large retail brokers as they start to break into the alt space.
Yeah, it really is interesting to see how it's evolving and in a short time as well. Chris, I'm sorry, you had a thought to add.
We're talking about the IPO market, and you talk about the alternative investment. We mentioned a little bit before off on camera, looking for different avenues to invest into a company, especially for growth. And what we've seen for companies is that there is plenty of money out there on the sideline, but you're going to get 4 to 4.5% on a 10-year right now. You get a little bit closer to the 5 on a 2-year. Growth is still the key driver here, but it's not growth at any cost, is what we saw in 2021. So when you're looking at the quality of issuers coming forward, some are being rewarded and some are taking a haircut on the valuations, which is fine. You're looking forward to the longer term for a lot of these companies. When you're looking in the alt world, you have a lot of different opportunities for people to put money anywhere else. Real estate's still booming. Are you seeing that some of your clients want to go into pre-IPO companies, or are they looking to just diversify into 3 or 4 different categories?
Yeah, it's a great question. I think one of the things to point out before I answer that part of the question is, if you think about the business that we're in, which is the self-directed IRA business, there's $12 trillion sitting in retirement vehicles, and less than 5% of that is in alts, which is an extraordinary thought, right? And so I think there's a huge demand for these private companies getting in at early stage, both individually at a company level, but also access to early stage venture capital funds. And so that's a way to mitigate risk, still participate in these early company opportunities, but not necessarily place your bet on a single company. And so, yeah, there's a tremendous amount of growing interest in that.
But investors are also more discernible than they ever have been in that space as well, I would venture to say.
Yeah, absolutely. I mean, I think it's because, you know, choices abound now in this space. And I think that, you know, investors have a number of ways that they can address their diversification needs in alts. And so they are more discernible. I think diligence around the assets that you offer is critical. I think that, you know, that's one of the things that we sort of put at the top of the list of things we do well, which is to make sure that if we're offering assets to our investors, that they are top shelf assets, that they've checked every box on diligence that we could possibly check. And so we can assure our investors that, you know, while you can never guarantee returns, what we can guarantee is that they're investing in a high quality asset.
But you're seeing that as well, Maddie, in the smaller cap companies that you cover, right? And that's why we ask that question, even if, does it really matter sometimes if there's interest rate cuts? Investors are more discerning and they want to see a healthy balance sheet. There's cash, they're not in debt. I mean, you know, all the basic things, but you see that in the small cap space.
Yeah, I think they're looking at the fundamentals.
Right.
Macro is only a part of it, but especially some of the small cap biopharma companies, the fundamentals are the most important because they're working on a study or a drug that is either going to work or it's not. And so that's what investors are really looking at. And the macro picture is just an added kind of concern.
Right.
Well, I mean, that's what it comes down to, right? Interest rates for smaller cap companies are, you know, they're very interest rate sensitive because they need to tap into funding to continue their business model. 40%, a little bit more now, of the Russell 2000 index is cash burn. Right?
Right.
So when you're looking at a cash burn company, like an alt, you want to bring your best foot forward, but there's, like you said, Scott, there's no guarantee, right? And that's where a lot of companies will either succeed or fail. Now, if you're, as a general investor, if you're unsure and the risk-free rate is 4.5%, what are you going to do, right? And that's the question that comes down to. You want to give people an opportunity to diversify a little bit, but you also want to make sure that they continue to grow their principal moving forward. I think that's kind of where you are.
And I think just pointing out another trend, I think that's becoming more prevalent too, is you think about historically the 60-40 allocation, right? Equity to fixed income. And I think we can point to a number of studies and data recently that says that a 40-40-20 allocation, with that 20 stepping into alts, whereas before people might have thought that added risk to the portfolio, evidence says that it actually reduces risk and increases return. And so we're starting to see those types of changes as well in investor behavior.
All right, appreciate the insight. Thanks everyone for being on Trade Talks with us, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.